All right, I'm going to call to order the meeting of the Oklahoma City Post-Employment Benefits Trust for Monday, May 14th, 2018. The first item of business that we have is the swearing-in ceremony for our new member, Neil Garrison. You want to get the mic?
Place your right hand on the Bible, raise your left hand, and state after me. I state your name.
I, Neil Garrison,
Do solemnly swear
do solemnly swear
that I will support, obey, and defend
that I will support, obey, and defend
the Constitution of the United States
the Constitution of the United States
and the Constitution of the State of Oklahoma,
and the Constitution of the State of Oklahoma,
and that I will not knowingly receive,
and that I will not knowingly receive,
directly or indirectly,
directly or indirectly,
any money or other valuable thing
any money or other valuable thing
for the performance or non-performance
for the performance or non-performance
of any act or duty
of any act or duty
pertaining to my office
pertaining to my office
other than the compensation allowed by law.
other than the compensation allowed by law.
I further swear
I further swear
that I will faithfully discharge my duty
that I will faithfully discharge my duties
as trustee
as trustee
of the Oklahoma City Post-Employment Benefits Trust
of the Oklahoma City Post-Employment Benefits Trust
to the best of my ability.
to the best of my ability.
Congratulations.
Thank you.
Well, Neil, we'll welcome you on the board. We're really glad that you're here. You want to tell a little bit about where you had served with the city and when you retired?
Yes, from 1978 to 2009, 30 years I worked with Parks and Recreation Department. I was the naturalist at Martin Park Nature Center in the northwest part of town.
That's very good. We're glad to have you here and appreciate your service with the city, and we're glad to have you on the board.
Thank you.
Thank you. All right, the next item we have is a resolution recognizing the service of Frank Wanto on our board. So Frank, if you'd mind coming forward, we'll let you just come to the podium here. Francis is going to read the resolution, and then we'll take a vote on it and let folks say a few words here before you go.
Whereas Frank Wanto earned a master's degree in public administration from Northern Illinois University. And whereas Mr. Wanto began his career with the village of Lombard, Illinois as an intern, and Mr. Wanto served as Director of Employee Relations for the city of Muskegon, Michigan from 1968 until 1974. Mr. Wanto served as Assistant Labor Relations Administrator at the city of Phoenix, Arizona from 1974 until 1987. Whereas Mr. Wanto formed Mission Consultants and operated as an independent consultant from 1988 to 1991. Mr. Wanto served as Labor Relations Manager for the city of Oklahoma City from 1991 to February 2002. Whereas the Oklahoma City Post-Employment Benefits Trust administered the oath of office for Mr. Wanto on November 23, 2009. Now therefore be it resolved by the trustees of the Oklahoma City Post-Employment Benefits Trust that they do hereby commend Frank Wanto for the service and dedication that he has provided to the Oklahoma City Post-Employment Benefits Trust.
Well, Frank, we want to thank you for your service with both for the city and with the Oklahoma City Post-Employment Benefits Trust. And thank you for your time and your faithfulness here and your dedication. His wife, Grace, is here with him this morning, too. And I thank you for sharing him with us during this time. And thank you for your years of service. So we are going to take a vote on I'll take a motion, and then we'll take a vote on the resolution, and then I'll let the other board members make comments.
I'll so move.
Second.
All in favor?
Aye.
Aye.
Any opposed? All right, Ted,
Frank's been my great pleasure to and an honor to have served with you as the other old retired guy on this Opebt trust. You've been a friend and a confidant, and I will miss you. Neil, welcome, but Frank, Godspeed in your future endeavors.
Thank you very much.
Laura?
Frank, I just want to thank you for your service to our trust. You know, when Francis read the resolution, it came back to me how long it's been that we've been doing this, and when we first started, it seemed like such an impossible hill to climb to make sure that our future retirees are protected in their retirement health benefit by having this trust available to them. So thank you for getting us started with that and keeping it going on such a great path. And we really appreciate your willingness to serve, your willingness to become educated about our OPEB requirement, and continue to support that. Thank you.
Thank you very much.
Yeah, again, I do thank you also for your service. I worked with Frank pretty closely when he was in labor relations and knew him there, and then when he came back and was working on the OPEB trust, and when I got on after him, I just appreciate his faithfulness, always here, faithfulness, again, like Laura said, to attend conferences and be a part of this, and so I really do appreciate your service here. Would you like to make any comments?
Well, I'd like to say, first of all, it was probably the most enjoyable public service that someone could imagine. And that's a factor of working for a great city. And I think that's why I've never considered living anywhere else after retirement. I'm not from Oklahoma. But it became really the center of our lives in so many ways. So I appreciate that, and having appreciated also the opportunity to work with most of you over a long period of time. Thank you very much.
Thank you. Thank you, Frank. Appreciate it. The next item that we have is to approve the minutes of the meeting for February 12th, 2018.
Move approval.
Second.
All in favor?
Aye.
Any opposed? Sorry. You ever have a chance to vote no if they want to. Next item is presentation of the investment performance review for the period of March 31st, 2018. And we also have our flash report and the quarterly report. Doug Anderson is here with ANCO.
Good morning, everyone. It's been great working with Frank. It's been great working with this board. I work with lots of boards, and not all of them are as stable or as conscientious or as interested in the work, but I think that this group really has interest and skin in the game in this in the management of this fund. So it has been great working with Frank, and I'm trying to think back to 2009, which was about when I came on board here, and I can't remember too many other changes on the board. So that stability is very, very important when we're trying to build a long-term plan for a portfolio. So I will try to be brief here, going through the market environment on the quarterly report, the thicker March 31 report, looking at performance of the markets. It was a little bit shaky. February and March had some pretty significant drawdowns in the equity market. If you look on page 2, under the market environment, you'll see that the top chart there is performance for the quarter. You can see a lot of negative numbers there, and it's been quite some time since we have seen negative returns in this magnitude or in this number in our quarterly performance. But then you look down for the one-year performance and how strong returns are there. I would say from a very, very high level, markets are tending to be very news-oriented today. We have seen some volatility return, but also we have seen some good results from our managers that we've been waiting on for quite some time. Remember, we're not trying to be reactive to performance here. We're trying to build a very long-term diversified portfolio that has different sources of return, and we're starting to see some of those from some of the portfolios that have not done so well over the last 2 years, I would say. Looking at performance on page 3, this is equity market performance, domestic equity performance. Looking over the quarter, you can see a marked diversion here, or dispersion. On the left are the negative returns, and that's the blue columns are for the value indexes. So if you were value-oriented during the first quarter, you had a very difficult time. If you were growth-oriented, it was much easier for returns. And if you see that when we balance the two, or we put the two, the value and growth together, you saw negative returns in the equity market and larger losses amongst the larger companies. Again, return to normalcy on volatility. Looking down for the last 1 year, you can see how that dispersion, pretty significant there too. I don't remember seeing growth outperform value by this margin for quite some time, especially this late in the stage of an economic expansion. Remember, we're 9 years in. We're coming up pretty close to 10 years since the great financial crisis. It's amazing. We have unemployment is very low. GDP growth appears to maybe be accelerating right now, but I don't think that we're at the escape velocity. We're not going to see any return to 5 or 6% growth, but growth has come in pretty strong. The expectation for the second quarter of this year is above 3% annualized, and that's a good, stable growth. I hate to harken back to the 1990s, but it's sort of Goldilocks economy. It's not too hot, it's not too cold, and it appears that the Federal Reserve is actually being able to pull back some of the stimulus, the massive monetary experiment that we had coming out of the great financial crisis, and we're starting to see short-term interest rates move back higher, and that helps savers. And it gets us to the point where if we do have another economic crisis, they'll be able to cut rates to stimulate as well. So a lot going into that. If we look at performance on page 4 as by sector, you can see also very wide dispersion of returns sector by sector. One that we're familiar with here is energy. If you look for the Russell 1000 over the last 1 year, it's down modestly. At the quarter, it's down 5.8. And of course, for the month of April, that was the best performing sector of the marketplace. Looking at earnings reports for companies, earnings for energy sector, year-over-year improvement is over 100% over last year. So energy sector is performing much better. The median return or the median earnings growth year-over-year for the S&P 500 is better than 18%. What's going into that? A lot of that is tax cuts that happened last year, which are being embraced by the corporate community, and also we're seeing some nice growth coming from overseas. So that's about enough on market performance there. Any questions? Bonds a little shaky during the quarter as well. But if I could ask everyone to turn to page 10. The trailing 12-month return, this is as of March 31st, for the total fund was 11.2%. We're very, very pleased with this. It's an excellent rate of return, especially for a portfolio that is this cautiously allocated. Page 12 shows the impressive growth of the fund from 2009, starting at $4.6 million, a little bit more than that, going up to $51 million. Again, that's pretty amazing growth, and I know that the liability is huge here, but we can be pretty pleased with how strong the growth of this fund has been. Page 13 shows asset allocation. Again, I always like to point back out to this when we're going back to the 2009-2010 period. We were, I guess you'd say if we erred on the side of caution and prudence at that time. We didn't invest a lot in equities because at the time, honestly, it probably looked like equities and felt like equities was going to be kind of a black hole of returns. So we were cautious at the outset to preserve the initial principle that was invested in this trust. Our allocation now on page 14, you can see domestic equities at 62%, core fixed income at 16.8%, international equity at 10%, active duration fixed income at 8%, high yield fixed income at 2.9%, and a very modest amount of cash. And this does not contain the cash that's held outside of the trust for normal cash flows. Page 16, for the 1 quarter ended, this is a cash flow statement. I like this. Started the quarter 1/1 of 2018 with $51.352 million. Contributions were modest. You can see contributions and distributions offsetting each other. Income of $111,000, and you can see a negative return on depreciation. So for the quarter, the total fund was down. Equities were up $212,000, and that came from Stevens. Very strong result for the quarter. The total fixed income composite was actually down, and of course our hedging portfolio was the reason why. 30-year treasuries react pretty poorly when interest rates move higher. If we go to page 17, For the quarter, the portfolio was down 0.41%. For the trailing year, 11.16%, and that's versus 10.23 for the policy index. So we've seen some marked improvement here. A return to volatility, a return to active management, playing some role in adding value was very helpful. If we go down the list, you can see for that 1-year rate of return, the ranks of the individual managers are very, very high in almost all categories. So the Loomis Sales Bond Fund, which is 8.5% of the portfolio, was first amongst core fixed income portfolios. 4.32 versus 1.2. That's a fantastic rate of return for a bond portfolio. If we look for double line, the next one below that, similar process, similar fishing area, if you will, 2.58%. Again, versus the same benchmark and ranked in the 4th percentile. Our high yield fixed income was up 467, outperforming the benchmark and ranking in the 12th. Looking down to Hoisington over that 1 year, remember this is sort of very high highs and sometimes very painful lows on this portfolio, but again, it's a multi-purpose portfolio. Over the last year, it was 4.54%. Remember, there's no credit risk to this portfolio. The price changes we see when you own a 30-year Treasury bond can be rather dramatic, but they can be very helpful during periods of extreme market volatility in most cases. The index fund over the last year tracked its benchmark very closely. The Vanguard Mid-Cap Index was up 12.19%, and that's feeling much more like a better decision to split up the mid-cap allocation between that index fund and then also Hotchkiss & Wiley. And I will spoil the surprise, but for April, Hotchkiss & Wiley was by far the top performer in the portfolio because they hold quite a bit of energy allocation relative to their peers. But over the last year, they were up 4.85. Stevens is a manager who is on alert right now, and you can see that their process, like I've contended all along, their process is not broken. They just need a reasonable market environment that proves selectivity matters. And you can see that over the last year, they're 21.79%. 5-year number has not yet recovered above median, but that 1st percentile rank for the quarter, very helpful. Tripled their benchmark rate of return virtually for 1 quarter. Stock selection. And then our international equity, our value-oriented international equity, did struggle during the quarter. Over the last year, up 13.5%. So really waiting for that one to come back in. I like Causeway, and I think the situation that we're seeing with them is about what we saw last year with Stevens. It takes them a while to establish portfolios, but it sometimes can be pretty slow to come around. But if we look down on the following page, on page 18, you can see that we have some managers who stay pretty close to their benchmark, and those are the index funds, and our bond managers are that way too. But if you look at the year-over-year ranks and returns here, I like looking at that to give a little bit more historical perspective. So, for instance, Loomis Sales Bond, the very top line there, not only are they great this year, they were great last year. 17 and 16, but remember back to 2015, they were not great, but they have rebounded. You can see the strength of that rebound. You can see double line bond, not quite the 1st percentile, but definitely top quartile, stable, constant returns from that portfolio versus peers. And then as we look down, I was just talking about Causeway. During the year 2017, they were top quartile of their peer universe. Again, it's a cautious strategy. Sometimes that does fall out of favor, but there's a lot of value locked up in that portfolio. Are there any questions about the individual managers there? I think it's good that we always remind ourselves of a couple of things here, and I'm going to ask you to make a big jump. We're not going to go through the individual pages. The portfolios are where they should be and manage the way that we expect them to. On page 40, this is the manager status summary. This is our reminder or our dashboard on how we feel about these managers. Stevens Small Cap Growth are on alert because of performance. They're our only manager on alert right now. While I think that Causeway should perform better going forward, I think they should be pushed on alert because over the last year their returns are in relative space not that great. Stevens, I'm going to say to upgrade them to in compliance after that very strong rate of return. Even though that 5-year return is just below median, I really like to see that they've they've come around as quickly as they have. And that's all the suggestions that I have on that, or recommendations I have on that page. And as we move on to the following pages, on page 41, our fees versus category average, our weighted average expense ratio for the investments we have is 49 basis points. The category average, if we just take the average of the categories that we're invested in, you can see it's 83 basis points. So we are 33 basis points cheaper, better than 1/3 less expensive than the index alternative, I guess you would say, or the median, or the category average, I would say, which is great for fiduciary management. It's good to be able to have this in your file. And as we go on the following page, on page 42, we try to keep these fairly close to one another. We have let some of the bonds, we've shifted that around a little bit. Hoisington, remember, is our big hedge to risk. And we have that's riding a little bit higher than our core fixed income portfolios, but that's by design. And if we do need to take capital for any reason, we'll be taking that from Stevens, small cap, as they have performed so well. That's something that I hope we can all appreciate, is that with frequency of cash flows, we can buy low and sell high much more often than we would. And that's a critical part to the long-term compounding of results. We've got diversification. We have value, we have growth, we have large, we have mid, we have small, we have domestic, we have international. We have short duration fixed income, we have core fixed income, and we have long duration fixed income. So really, in my mind, this is a very well-diversified portfolio. We know where the risks are, and we know where our shock absorbers are too. And the managers have started to perform better. There's been a long time since we've seen active management perform much better than passive. However, in the large cap area, I don't think we should go back there as active. I think the passive exposure is worthwhile in that area. So that's the quarterly report. The only changes that I would like to make are to swap the manager status on Stevens and Causeway and change one to in compliance and put one of them on alert.
I was talking to Francis about whether or not we actually vote or take any action on the manager status. And I think what we've done in the past is that you're just setting that status and notifying us of what we're doing. Okay.
That is my recollection.
Are there any questions on the quarterly report?
Not a question, but I would imagine that under item 7, we could take the action to recommend the change.
Have we taken action on that? I mean, do we actually do board action to make that change, or is it just the managers doing that on our behalf?
I thought we had on alerts.
I was thinking it was just for a change in allocation.
Okay.
Okay.
It does also says, or changes to portfolio fund managers, which I would assume could mean on alert if we decided to do that.
We made that a standing
Right.
item.
Yeah, but I think it's just if we actually change a manager, that if we drop a manager and add a manager or make a change in allocation is where we've taken the action.
Yeah, that's correct. I think in the past, many years ago, that did take a board vote, but I think that not the last time that we reviewed investment policy, but the one before that, I think that we changed the mechanism for the status there.
Okay. Did you have anything on the flash reports?
Yeah, just very quickly, if I would. If we go on the flash report, this is as of April 30, just getting a review of this. Equity markets were modestly positive during the month of April. But if we look back on the market environment page, you can see that February and March, pretty rough. You know, we've not seen losses like that, and we're starting to recover and dig our way out of those. Looking at the performance for the total fund composite, we were positive for the month, negative for the quarter, but we really held in versus the index. The index was down 4.17. We were down 3.12, which is painful, but we did recover some of the value there. If we look for the trailing 1 year, we're still in double digits at 10.53. And then we don't have ranks for the individual managers. Just wanted to point out here, looking at Hotchkiss and Wiley at 524 versus their benchmark was down 15 basis points, but they were up 5.25%. This is why we have patience with Hotchkiss and Wiley because they can build returns very, very quickly. Looking down that list, Causeway, pretty close to their benchmark, but Stevens still outperforming pretty well, especially look at that one-year return for Stevens, 21.15 versus 16.6. So, again, economically speaking, things are pretty stable. I think last time we were talking about North Korea as the potential big macroeconomic risk. Looks like that may be declining, hopefully, knock on wood. But as soon as we say that, it seems like somebody else steps right into their place, and we've got Iran as the new menace out there right now, I guess you could say. Mm-hmm. Always something.
Yep.
Always something to worry about.
All right. Thank you very much, Doug.
Thank you.
So could I get a motion on item 6 to receive the monthly fast investment flash reports for February, March, and April 30th?
Second.
All in favor? Any opposed? All right, thank you very much, Doug. Appreciate it. Item 8 is the acceptance of the interim financial statements for the 9 months ended March 31st. Jake Siebenaller from our Accounting Services Division is here with us to go over the report.
Good morning. Thank you. Just want to highlight a couple items from the quarterly report. So if you'll flip to page 3 of the MD&A. After the third quarter, the trust is reporting a net position of $56.29 million. This is an increase of $9.91 million over the prior year when the net position was $46.38 million. In comparison to the same time period for the prior year, contributions have remained constant at about $20.7 million, with benefits paid have decreased $3.2 million. Investment income in each year has remained fairly constant, coming in slightly below $4 million in each year. For comparisons, the trust net position increased to $5.22 million through the third quarter of fiscal year 17. The next item we want to look at is if you'll flip back to page 10 under the notes section. At the bottom of page 10, the money markets used to pay claims are reporting at $5.1 million. This is compared to prior fiscal year value of $2.9 million, which is reported at the top of page 11. Are there any questions or anything I can answer at this time?
Are there any questions on the financial report? All right, then I would take a motion to receive the report. All in favor? Aye. Any opposed? All right, thank you, Jake.
Thank you.
The next item is to approve our renewal with the agreement with BOK for custody services, retroactive to May 9th. Can I get a motion on that?
So moved.
Second. All in favor? Aye. Any opposed? Item 10 is approve the third amendment to the agreement between Oklahoma City Post-Employment Benefits Trust and NIHART. They do our actuarial study for us. Could I get a motion on that item? Second. All in favor? Aye. Any opposed? The next item is a joint resolution authorizing an amendment to the Administrative Services Agreement between United Healthcare and the City of Oklahoma City and the Oklahoma City Post-Employment Benefits Trust on plan design changes. Chris, did you have anything on this?
I don't have a presentation, but happy to answer any questions.
Okay, this is really aligning with the changes that were approved in our contract negotiations, and it's already been approved by the city for plan design changes that will then also affect the retiree plans.
Yes, sir.
Okay.
I have a question if I may. As I read the documents, this affects only active members, COBRA, and early retirees. Is that correct?
That's correct. So the individuals that are actually being affected by the change would be those folks who are under 65 and on the HMO plan. I believe it's right at 150 members, and then their dependents as well.
So the percentage of people represented by the actions of this board is relatively low in terms of the total population of Opebt.
Yes, relative to the other plans, it's a very small membership.
Are there any other questions? All right, I take a motion.
And my only reticence is because language is important. This is a $1.6 million savings to the city. It's a $1.6 million cost shift. I'm sorry, it's a $1.6 million cost shift to the people that we represent.
May I address that, sir, if that's
Please.
all right? So certainly impact to the member is a heavy part of our analysis when we look at these changes. This one in particular was made because it's necessary. Unfortunately, we're staring down 7% all the way up to double-digit increases every year, as you folks well know. And so this is one of the, I don't want to say pain-free, but lesser painful ways to approach that. And I feel like the benefit there is if we do the quick math, members saved about 6%, or the plan saved about 6%. That's that $1.6 million for the remainder of the year. That's actually shared 50-50 in terms of our 150 people that we're talking about. And so those individuals, depending on whether they're on an employee-only plan up to a family plan, would save anywhere between $400 up to $1,200 in premiums per year. We prorate that, you're down to $800 or so for the remainder of this year. But so if we look at that in terms of how many times we go to visit the doctor, we're looking at a $15 copay moving to a $30 copay. If we do the quick math with a family, you'd have to see the doctor almost 100 times to not be ahead with this change. Now, there's also some prescriptions in there that went up slightly depending on their tier. So we'd have to do the math per member, but by and large, the vast majority of our members will save money and be ahead because of this change. So I just really want to say that it was made intentionally so that we could share the savings between the member and the city.
And because the retirees are basically we're almost at 50-50 now between the city's portion and the retiree portion on premiums.
Right.
Anything that's saved on the city side is an equivalent savings on the retiree side.
Yes, sir.
As far as in premium.
And I appreciate that explanation. I feel better from that. And let me say that I think the insurance packet, which you guys negotiated this year for retirees, and the work that's been done on the city clinic, I think are wonderful advancements for retirees. And that is not a complaint at all. I
Understand.
appreciate your explanation. Thank you.
Thank you, Chris.
Chris, can I also clarify, the $1.6 million of savings is to the entire covered group, not just the retirees?
Yes, ma'am. So if we get down to just the 150 or so individuals that would be covered out of Opebt, that savings is just shy of a couple $100,000. As we said, it's a relatively small portion of the membership.
Thank you.
All right, so I've got a motion and a second. All in favor?
Aye.
Any opposed? All right, thank you, Chris. Next item is to approve the fiscal year 2019, the FY19 annual budget, establishing the revenue and expenditure budgets for the Post-Employment Benefits Trust. Lindsay Baird is here from the Budget Office to give us a brief presentation.
Good morning. I'm Lindsay Baird from the Budget Office, and I'm going to present the FY19 budget to you. The total budget for the year is $29,411,483. It's a decline of 7.5% from last year's budget of $31.6 million. The biggest decrease is due to the reduction in the indemnity premium expenditure line. This is due to two factors. First, the enrollment in the indemnity plan has decreased from last year by about 10%. We're shifting a lot of those participants to the Medicare Advantage plan, which is much cheaper. Second factor is a switch in the prescription provider from Express Scripts to Blue Cross Blue Shield. Prior year, we had received revenue from Express Scripts in a rebate, and that's that revenue line of refund and reimbursements declining from $2.6 million to zero. This year, we're switched to Blue Cross Blue Shield, and they're giving us the rebate as part of a reduction in the administrative fee. So that's that reason of the $4 million decline in the indemnity premium. Also, another decrease is, or an increase is the HMO premium. That increased approximately $1 million. That's due to an increase in enrollment and an increase in premium cost. In FY18, we're anticipating adding $3 million to the fund balance. And for FY19, we have budgeted $1.2 million in reserves to continue to increase the fund balance. So we're hoping to end the FY19 year by adding that amount to a total of $50 million. So with that, any questions on the budget?
Are there any questions on the budget? All right, I'd take a motion to approve the budget for fiscal year 19.
So moved.
Second. All in favor? Aye. Any opposed? All right, thank you very much. Next item that we have is ratifying the claims listing.
Move them.
All in favor?
Aye.
Any opposed? Are there any other reports or comments from staff or from the board? Again, Neil, welcome aboard. We're glad you're here. We need to make sure and get him information too on the trustee education that's in September, to make that available. Just remind me to do that. All right, and with that, we are adjourned.